put the title of this broadcast, Party Like It's 1999. It feels in the stock market very similar to 1999, and I will explain later. I'm Ben Reppond. Welcome to my YouTube broadcast. Today is May 30, 2023. You may remember 1999, the late 1990s, but especially 1999. The market was going up and up and up. You almost didn't have to look. You just knew it was going up. And what was interesting was that the market was focused primarily on dot-com stocks, technology stocks, but they were more specifically were dot-com related. The rest of the market was really not participating, or at least participating very much. It was technology that was driving the market and dot-com in particular. And here we are in 2023, 24 years later, and what is driving the market? AI. AI is the current equivalent of dot-com at that time. This has all happened. It's a very short period of time, just from the beginning of 2023 until today. The technology in particular, and just really a handful of stocks, is entirely or almost entirely driving the market. And I'll show you some of this data later. As I saw this chart right here, it reminded me of 1999, of that bubble that went way up. And then, of course, we know, you can see the left side of it, what happened after that. I'm not going to say, because it would be incorrect, I'm not going to say that that is going to replicate itself, because that was driven by companies mostly who had no earnings for sure and who had very little revenue. They had a story and .com after their name. And of course, there was no substance there. However, people like Jim Cramer were telling a story in so many words, it's going to go to the moon. I remember Henry Blodgett, who was the technology analyst at Merrill Lynch, and I think he said literally he expected the NASDAQ to go to 50,000. It eventually went to 5,000 and then crashed somewhere down around 1,000. No, it did not go to 50,000. It crashed. I'm not saying that AI is going to do the same thing here, but it is definitely pushing tech stocks to a level of overvaluation to the point where it just feels like 1999. What is this correction going to look like, and when is it going to come? I don't know. But I'm going to unpack this, and I'm actually going to show you both sides of the story. I'm going to show you the case for and the case for against. This illustrates my point. Tomorrow, I'm going to show this slide to break down the sectors, and in the yellow box and just to the right, you can see the broken down by sector what this looks like. At the very top, you see technology has had a gain of 32%. Consumer discretionary, a gain of 17%. After that, look at the rest of the market. It is just not participating in these gains. It is mostly driven by a handful of stocks, and the rest of the market is mostly down. That picture looks so much like 1999, I couldn't avoid doing a broadcast on this subject. This also reminds me of Hyman Minsky. He was a professor of economics. He graduated from Harvard with a PhD in economics and taught at Berkeley and at Washington University, and was known eventually for a paper he wrote in 1992. He eventually died in 1996. So he saw nothing. He saw nothing that happened after 1996. But he came up with this thesis, which was the greater the stability of the market, this is the essence of it, the greater the stability of the market, the greater the instability that follows. And his thesis was based on the fact that the market is basically unstable. It is always unstable. And however, it is propped up during periods of time that make it look like it has stability. And so stability is followed by instability. And you can see that on the chart on the right. I took these pictures from the Forbes article that was written not long ago on Minsky. And this circle shows really what he was saying. This period of stability is followed by this period of instability, which ends in panic, capitulation, and so forth. So, certain things drive that. Uh, each time it's a little different. I would not say that we are directly headed into that right now, this month or next month, and I don't know, maybe even this year. I don't know. But I know at some point, according to Minsky, the market gets so elevated and so frothy and so built up that it eventually just collapses and instability takes over. The but that chart I just showed you on how disconnected, I'll bring it up now, how disconnected the rest of the market is from these few stocks. The Nvidias and Facebooks and so forth, they are driving the market, and the rest of the market is down mostly. So it is very much plays into the hand of Hyman Minsky, and this article talked about, are we at another Minsky moment? And that's sometimes now what it's referred to as Minsky moments. Um, so I'm going to play this clip. I'm going to show you both sides of this. And Mike Wilson, the chief investment officer at Morgan Stanley and U.S. equity strategist, he has said since last December that we are headed into a probably more than a correction, that the market has got to come down because earnings, particularly the price earnings ratio, is too elevated. And he's been pressed on this and pressed on this. This this interview is so interesting because it's a Bloomberg interview that is done by Tom Keene interviewing him, and Tom Keene is basically trying to set him up. And he's saying, you know, he says, do you want to recalibrate your bearish comments? In other words, I heard this as, do you want to recant? Do you want to just say, I screwed up? Because now this market is going, but it's only going for a short period of time, and it's going with a very few stocks. It's very narrow, and it is very brief. And Mike Wilson responds to Tom Keene's attempted setup. And and is very nice to him actually. After this, after I play Mike Wilson, I'm going to have my son Spencer talk about this. By the way, I want to comment. You probably don't recognize the fact that I'm not in Montana, in my log home. But I'm in Seattle, and I'll explain later why I'm in Seattle. But part of being in Seattle is it gives me an opportunity to be with Spencer, and he's going to comment also because he follows Mike Wilson like I do, and he'll comment on this after I play this clip from Mike Wilson. Okay, take a listen.
What are you writing this weekend to recalibrate a cautious call?
Yeah, good to see you guys. I mean, our call really hasn't changed. We're very disciplined on price, and as you know, we got tactically bullish last fall at 3,500 because that was a good price, and now we're of course back to the high end of the range, and that's not a good price. And that's at the S&P level. That's not really what's been interesting over the last 6 or 7 months. As you know, what's been interesting is what's going on under the surface. I would say in the fourth quarter, that was a very hated rally because it was led by kind of the old economy, financials, industrials, energy, materials. It was all based on, the China reopening story, which was legitimate. And technology stocks obviously disappointed, and they did not trade well in the fourth quarter. So it was a hated rally because that's what people own. Now, of course, the S&P is trading at the same price it was in early December, when we got cautious again. And tech is obviously going to the moon. And now this rally is loved because these, this is what people want to buy. This is what people want to own. It's a lot more interesting and, kind of exciting to own AI and technological revolution than it is to own some those old economy stock. It's, well, why do I want to own this long term? So it's just an interesting development. We would characterize this as the bear market is continuing. Okay, this is what bear markets do. They're designed to fool you, confuse you, make you do things you don't want to do, chase things at the wrong time, probably sell them at the wrong time. And we think the overriding driver, okay, of this year's rally has been increased liquidity. Liquidity has improved dramatically, both on a global scale, and the weaker dollar has helped. That's going the wrong way now again. And then, of course, ironically, the banking failures that happened in March led to an injection of liquidity from the FDIC and the Fed. And we think those things have really conspired to drive the market. I mean, nobody talks about the fact that crypto is up 60% this year, okay? And then the next one, of course, is the tech world. So this is what's going on. We think that the fundamental case does not support, where stocks are trading today, whether it's at the index level or at the single stock level. And the second half is going to be a bit choppier and probably downward in the index.
I always enjoy listening to Mike Wilson because he paints a very sober picture of the market and is able to back up his assertions with strong data. Despite the fact that we're in a cyclical bear market, my perspective is that valuations are still overpriced at these levels. And it's not just the top 10 to 20 stocks that are overpriced. The price to earnings multiple for the S&P 500 in aggregate is sitting at 18.3 times today. This means that it's sitting within the top 15% of PE multiples going back as far as the mid-1990s. On the earnings front, consensus is expecting a low single-digit reacceleration of earnings going into the back half of the year. Mike Wilson and Morgan Stanley's perspective is that the current consensus is overstated by as much as 20%.
So thanks, Spencer. So what he said was the market is overstated by 20%, according to Mike Wilson. So what that means is if that's true, then what we're looking at is not a market collapse at this point of, down 50% or more. We're probably looking at some kind of a correction of 20%. Maybe if it overshoots, maybe 25. But it's not. There's two views. One is that the market is just going to keep on going its trajectory to the moon, so to speak, or it has this correction, call it a correction if you want, down maybe 20% from here. But I'm going to play both sides of it. So I will begin by playing this piece from Mohamed El-Erian, and Melissa Lee at CNBC is interviewing him, and his is a more optimistic view than Mike Wilson's. And so if you want to hear the other side of it, this would be his view. And his point is that instead of like what Spencer said, the market being 20% overvalued, he's saying it's fairly priced. In other words, it's not overvalued. And he makes tries to make a case for that. So I want you to hear this from Mohamed El-Erian.
Let's bring in Mohamed El-Erian, the Chief Economic Advisor at Allianz and President of Queen's College at Cambridge University. Mohamed, always great to see you.
Thank you for having me, Melissa.
With the S&P close to 4,200, Mohamed, it feels like the stakes are even higher for there to be a deal on the debt ceiling and for there to be a deal before this X date, just because of the valuations that we're at right now.
I totally agree. First, the only people who benefit from this debt ceiling saga are the adversaries of the United States. We are sending a very negative signal about our ability to run our economy, let alone be an anchor for the rest of the world. And the market so far has actually dealt with it very well. There's three big uncertainties: the debt saga, whether the Fed is going to hike, pause, or skip at its next meeting, and of course, what's happening to credit. So I look at this market and actually I'm very impressed by how stable it has been over the last month.
So there are a couple of ways of looking at the S&P 500 and how far it's come and how well it's held up. One way is to say, you know what, it's stronger and more resilient than we think. Or another way to look at it is that we are much more vulnerable because of the heights we are at right now, because of the concentration of the gains in the large caps at this point. What's your view of where we are?
I mean, you're absolutely right. It gets even more so because the S&P has been anchored by what I call all-weather names. Tech in particular, that is seen as doing well, that is seen to benefit from the AI theme, and that is seen to be able to generate revenues almost regardless of what's happening in the broader economy. So you have a situation where you've had a few names anchor the market as a whole, and then people are waiting. So this is what I call an unstable equilibrium. It's going to go one way or the other. Hopefully, the S&P will go higher because these things are going to resolve to the positive side. But it is uncertain. We are fairly priced for what we don't know, and we just need to figure out when are we going to find out, including the Fed. The Fed is going to play a very critical role here.
Okay, now I'm going to play a clip from Scott Wapner from CNBC interviewing FundStrat's Tom Lee, who paints a more favorable view of technology than what I was describing earlier and maybe what Mike Wilson is saying. But again, this gives you the other side, so you can see that there's an optimistic side and there's a side that's more cautionary. And so the reality is we don't know. And the reality is I don't know. So we could play people as smart as Mike Wilson and Mohamed El-Erian or Tom Lee, and they all have opinions based on this or that. The reason I'm playing this is with our clients that are watching this, they know that I have a methodology and a strategy for dealing with this, for getting out of the market when the market tends to goes down. I have a method to deal with that. It's not perfect, but it's active, and I do pay attention to that. And what I'm doing is attempting to avoid as much of this risk as possible. Traditional financial advisors believe in just leave your money in, let it go all the way down, however far down it goes, and that's part of the ride. That's just the way you do it. Of course, we saw what happened last year, and that wasn't even a collapse. We saw that bonds and equities were correlated, and as interest rates and bond yields went up, bonds went down, but they went down when stocks went down, and that surprised a lot of people because they didn't have that baked into their methodology. So take a listen to Scott Wapner interviewing Tom Lee.
This tech takeoff and why some make the argument that it is not done just yet. That is the view of Tom Lee, FundStrat's co-founder and head of research. He is, as you can see, with us live. Welcome back. It's good to see you again.
Great to see you, Scott.
Doesn't want to let up. It certainly doesn't seem like it wants to. Why do you think it can continue, Tom?
Well, we know bull markets climb a wall of worry, and we know that there's a lot of things that we visibly worry about, including debt ceiling, inflation, the Fed, regional banks. But I think the message that's come out in the last couple of months is companies have been incredibly resilient. They manage costs really carefully. They've been selective in how they manage prices. They've been really good at targeting customers, and I think that's what's paying off. They had a great first quarter earnings season, and as you know, at several of these conferences, they haven't been cutting guidance. In fact, I think they've destocked, so I think there's still upside to earnings. That's one positive story. And the second, of course, is positioning, because people really did rage sell last year, but we know that the bond market is sort of signaling a softer landing than many were expecting. I think that's positive for equities.
So you think there's still going to be a chase to come, at least as it relates to tech, because you've gotten a year's worth of gains in these stocks, and in some cases you've gotten like 5 years worth of gains. It's been quite remarkable, and you know exactly what I'm alluding to, the fact that NVIDIA and stocks like that up 100% year to date plus, and don't seem to want to let up.
Yeah, I think what's interesting about NVIDIA is that this was not a widely shorted stock into the results. So that 30% rally was really the market recognizing they have to reprice the future cash flows. I think that's pretty true for most of the FANG trade. One of the reasons we thought it would be our top sector pick this year was that all this wage inflation and need to boost productivity was going to be solved by these FANG companies. And that ultimately translates into better than expected growth. I think that's really the thesis. And it sort of explains why FANG, has really led this year, but I don't find them actually expensive stocks.
Now I want to shift gears. I had a friend of mine sent me a text a couple of days ago, and he said this. I'm going to kind of disguise a couple of things here because it's not important, but the message was very significant, and people are talking about still a lot of bank risk and and currency risk, and people don't really they have opinions about, gee, is my money safe uh, in my bank, or is it safe in banks in general? So I got this, I got this text from this friend, and so I'm going to read it to you. And this was a picture that I just pulled up to illustrate the point. It's not the one he's referring to, but it illustrates my point. And my friend said this: my wife and I bank at a certain bank near our home. The bank has a new metal detector and security door, kind of like this, I imagine, in order to get into the bank. It sparked our interest. So we drove to a nearby town where the same bank is putting in a new branch there as well. Same thing there. Looks like the banks are preparing for a bank run. Now, I don't know if that's true, and I don't want to scare you, but it caught his attention that why would they do this? What is there that is a higher level of risk or threat and at banks that they would go to this level of expense and effort different from today or different from last year? What's going on? Well, I don't know, but I just thought I would bring it to your attention. And I'm not going to mention the name of the bank because it's not important. It maybe just illustrates that there is a level of need for security at banks that there wasn't before. I don't want to read more into it than that, but I just thought I would pass that on because it was such an interesting comment. Now I'm going to give you the flow of funds report from last week. Again, this is not dissimilar from what we've been seeing. Outflows out of equity funds, 6.7 billion. So when you see the that chart that I showed you of where all of the majority, vast majority of the sectors, 8 or 9 out of 11 sectors are negative. What that means is there's outflow going out of equities, not out of technology, not out of consumer discretionary, at least at this point. But and then bonds, there's a lot of money in bonds. So there was a outflow of 873 million, which is a drop in the bucket for what's in bonds. But again, it's going in the negative direction. And money market funds had an inflow of 46 billion. So it tells you there is a flight to safety. People are concerned that, about equity risk at this point. This is the reason I'm in Seattle. My daughter had a little baby girl. And so I was holding her yesterday, and her husband took this picture, and we were in downtown Seattle and in a high rise. But I thought that's why I'm here. And so, yes, I am doing my recording from Seattle, but it's great being able to hold a little granddaughter. If you have questions or comments, leave them in the comment section below and I will try to answer them. Thank you.